Can I actually get big banks to listen to this Clarity Act? Let's find out. The Clarity Act has been making waves lately, and its potential impact on the banking industry is a topic of great interest. At its core, this act aims to increase transparency and accountability within the financial sector, which could have far-reaching consequences for big banks. Big banks might be sweating because the Clarity Act could mean more stringent regulations and closer oversight. This increased scrutiny could affect their bottom line, as they might have to adapt to new rules and possibly face stiffer penalties for noncompliance. The act could also impact their business models, forcing them to rethink their strategies and operations. Another reason big banks might be afraid of the Clarity Act is the potential for increased transparency in their operations. This could lead to a loss of competitive edge, as their strategies and financials become more visible to competitors and regulators alike. Furthermore, the act might give consumers more power, allowing them to make more informed decisions about their financial dealings, which could reduce the bank's customer base. The Clarity Act might also force big banks to change their risk management strategies, which could be costly and time-consuming. They might have to invest in new technologies and hire more staff to ensure compliance, which could be a significant burden. All these changes could affect their profitability and even their reputation. The Clarity Act includes several key provisions that could significantly affect banking operations. For instance, it requires banks to disclose more detailed information about their financial dealings, which could increase transparency but also create competitive challenges. Another provision mandates that banks implement more robust risk management systems, which could protect them from financial shocks but also be expensive to implement. A crucial example of the Clarity Act's impact is its role in a recent high-profile case involving a major bank. The Act's provisions were used to scrutinize the bank's operations, leading to significant changes in its business practices. This case demonstrates the real-world implications of the Clarity Act and why big banks are taking notice. The increased transparency required by the Clarity Act can also lead to better informed investors, which could affect a bank's stock performance. Additionally, by holding banks accountable for their actions, the Act could help prevent financial crises. In a recent development, regulators have started using the Clarity Act to take a closer look at banks' climate risk disclosures, which could become a new standard for the industry. This move shows that the Act is not just a piece of legislation but a tool for active oversight. In summary, big banks are concerned about the Clarity Act because it could increase their operational costs, affect their profitability, and change the way they do business. As the financial sector continues to evolve, it's clear that the Clarity Act will play a significant role in shaping its future. So, what do you think about the Clarity Act and its effect on banks? Let me know in the comments below. If you're interested in more financial insights and analysis, be sure to subscribe and hit the notification bell.